Welcome everybody. In this video, we are going to go through a couple examples of how to work with depreciation rules for various assets. And then we're going to look at how we actually complete the depreciation section of the tax return. So first off, I just want to give an overview about this case that we're looking at. We have a company that basically opened up in 2018, and we're going to do their 2019 taxes. So they bought some equipment back in 2018. We're going to work through how we depreciate that equipment in the first year, 2018. And then we're also going to look at how the second year depreciation is done for the 2019 year. Additionally, they bought more assets in 2019. We're going to show how we depreciate those for that first year. So right up here, we have the three assets they purchased in 2018. They bought some furniture for $150,000, machinery for $1.56 million, and a delivery truck for $40,000. And notice they have the date placed in service. And this is really important because the date in which these assets were placed in service is going to determine the convention we use to depreciate them. So a couple things that you want to keep in mind before we even jump in with the numbers and examples here. When you're thinking about depreciation, you want to think about what type of asset we're looking at. So there's a couple different types of assets: personal property, real property, and personal use property. So personal property is tangible property that you're using in the course of operating your business. So office furniture would qualify for that. A truck would qualify. Machinery. All these things are tangible property. You're using it for your business, and they're not land or property. That's kind of our next section. Real property, that would be like buildings, improvements to buildings. And we're going to notice there's different methods to depreciate these assets based on what type of asset it is. There's a third category: personal use property. Basically, that's property you use just in your own livelihood. It has nothing to do with business. And I just wanted to put that up there because people do get confused between personal property, which is property used in business, and personal use property that we use on our own. And actually, there's another category that I'll jot down here: listed property. It's kind of dual use property. So think if you own a business and you buy a vehicle that you use for the business, but you also use it in your personal life. That's kind of a dual use asset. So there's special rules associated with that. We call that listed property. We're going to see in the second year of this example, the company actually bought a luxury automobile that can kind of fall under that category. So that's the first thing we have to think about when we're looking at these assets. And of course, depreciation is just recognizing expense over the life of the asset. We capitalize the asset when we buy it, so we don't necessarily expense the whole asset immediately. These depreciation rules help us figure out how much we can expense. And typically, we like to expense more up front from a tax standpoint because that's less taxes we're paying in the current period. So generally, you want to have as large of a depreciation expense as possible. Now, there are some exceptions to that. If you're going to have a loss, or maybe if you feel like you're going to be in a higher marginal tax bracket down the road because you're not making so much money now, but you feel like your fortunes are going to be a lot better in the future, then you might want to try to not take the full amount of depreciation in the current year. But for our uses for these problems, we're going to assume we want to take the greatest amount of depreciation as is possible. Now, once we figure out what categories we're in, then we have to kind of distinguish what rules we want to use. So right now for this first year, these are all personal property. So we're going to use the rules associated with personal property. And now the second step is, well, what convention do we use? So if you think about personal property, there's two different ways we could possibly do this: the mid-year convention and the mid-quarter convention. Basically, we're going to go with a mid-year convention for all this stuff. So if we look up here, and basically the half-year convention is the technical word for it. So what distinguishes these two types of conventions is how much depreciation we're going to take and when we put assets into service. So typically, you're going to use this mid or half-year convention when you have personal property like these assets we have here. Now, the one qualifier is that if we put more than 40% of all of our personal property into use in the final quarter, all right, we have to use that other convention. So in this case, notice most of the property we bought, a good bit of property here, 3 different expenditures. Most of it was bought actually in the third quarter, beginning of the third quarter in July. So in this case, we're not even close to 40%. We only bought $40,000. And actually, that was in the third quarter as well. So October, November, December for a calendar year, and that's the year that we're on here. Of course, companies can use different fiscal years, so we're doing it by the fiscal year. But for this company, they're on a calendar year, so first quarter's January, February, March, and so forth. So actually nothing was put in place in service in the fourth quarter, so we don't have to worry about that special rule. We're just going to use that half-year convention. Now, let's say a different circumstance. Maybe we bought like a piece of equipment in December and we paid $1 million for it. In that case, we'd have to add up, all right, all of our assets and see how much that million was. If that million that we put in service in the last quarter was more than 40%, all right, we have to use that other convention, the mid-quarter. But in this case, not even anything put in service in the fourth quarter, so we get to use the tables right here for half-year convention. So this is what we're going to follow to figure out depreciation for the first year for these 3 assets. So that's the 2 things you got to consider first off, right? What type of asset is it? All right, so personal down through this list. All right, if we know what type of asset it is, then we have to think about the conventions being used. So think about those rules in this specific case. Nothing's being put into service in the fourth quarter. We're not over 40%. That little rule doesn't apply, so we're going to use this half-year convention. The last thing we need to think about is the asset class itself. So the depreciation that we take on assets is determined by the life of the asset. So certain assets are expected to last longer in general. So the IRS has rules governing this. And notice furniture, we depreciate over 7 years. IT systems, cars, trucks, 5 years. Machinery, 7 years. So we're going to come back to those class lives in a second here when we actually calculate the depreciation. So what I'm going to do is go through a couple sub-questions for this. Then we're going to bring all this information together in the tax return. So our first question here is asking us, what's the maximum 2018 depreciation? And it's asking including 179 expense. All right, so this is section 179. This is a special rule that in 2018, we're able to take a $1 million expense right off the bat, depreciate $1 million worth of assets, tangible, real assets. It got kicked up in 2019 to $1,020,000, so we're going to see $1,020,000. We're going to see that number come into play in a second. So notice here, we're going to do the calculations for our maker's depreciation. But first off, we want to figure out if we're taking the 179 expense, we have a limit of $1 million, and we're going to apply that to the machinery here. If we go back and look at machinery, it has a 7-year recovery period. So we like applying the bonus depreciation, or rather the 179 depreciation there, because we're getting the most little bang for our buck because we're spreading out the cost of the machinery over 7 years. Imagine if machinery had a recovery period of 3 years. All right, we'd be taking a bigger amount of depreciation each year in that case. So applying that $1 million off the top wouldn't help as much in that case. Notice the other assets we have, the delivery truck, all right, it's only 5 years. Now the furniture is 7 years as well, so we could have split it up. We could have taken 150 and 179 expense for the furniture and 850 for the machinery. That would have been $1 million. It's covering both 7-year assets. But for simplicity, being that we have more than $1 million spent on this one piece of equipment, we're just applying the whole 179 expense to that. So what that means is we're going to be able to write off $1 million for that piece of equipment right off the bat. We could take that as an expense, thereby reducing our net taxable income, all right, which of course saves us some taxes. Now, notice after we take that $1 million away, our maker's basis is 560,000, just the 1.56 million minus a million. So that's what we're going to work with when we go to the table. So the reason you see zeros in these two other columns is because we took the entire $1 million for this one particular asset. We have discretion as to how we want to distribute that, but we want to try to maximize our savings, minimize our taxes that we have to pay. All right, so we applied it there. Now, what we're going to concentrate on is how we actually calculate this maker's depreciation. Again, these are all tangible, real assets. All right, so what we're going to want to do, and there's tables here. If you open up these tables, you have the different tables that appear in your book that show how to depreciate. So for this first one, again, we're using that half-year convention because we didn't place over 40% of our assets in play in the fourth quarter, so we could use the half year. What we want to do is for each one of these assets, figure out what its class was, and then just go to the appropriate column. So we're in year one, right? This is the first year we bought the equipment. If I wanted to know what the depreciation was in the second year, I'd use the year two row. We're going to do that in a few minutes when we look at 2019's depreciation for these assets we bought in 2018. But right now we're just thinking, we're putting ourselves in place of being in 2018, completing the taxes for that year. What depreciation would we take in 2018 when we initially bought these assets? So I kind of replicated over here those assets that we purchased. We have the three. This is our basis for all three of those. So notice furniture, all right? We said it was a 7-year asset. So what we're going to do is in the first year, in 2018, all right, year one, we look at the 7-year asset. We just go where the row and column meets. We have 14.29% depreciation. So convert that to a decimal. We got 0.1429. If you multiply that times the basis, that's how much depreciation we have, all right, in that first year for that particular asset. If you notice, if we go back to our key here, all right, that's what we got. Same idea for the machinery. Remember, we took the $1 million 179 designation, so there's a $560,000 basis. That's the base which we're going to depreciate from for the entire useful life of this asset. So if we come down, same idea here. Notice machinery. All right, we said it also is a 7-year asset. If we go back to our chart here, again, year one, same deal as before, 7 years. So this is basically the same percentage we used for the first asset, 14.29%. What I'm doing is multiplying that 560 times the depreciation percentage. All right, we get 80,000 and change in depreciation for that year. Truck, a little bit different. Remember, trucks fall in the 5-year category. So when we're looking at that, again, we're looking at it for the first year of its life. Well, it's a 5-year asset. We're at 20%. That's the percentage we use to depreciate it. All right, so we take that 40,000 times 20%, you get 8,000 in depreciation. And we could see, we go back to the question here, that matches up. All right, so that's how we do in the first year of operations, depreciation calculations for real tangible assets when we have a situation using that mid-year convention. Now, second thing we're going to look at is 2019's depreciation calculation. So going back to the beginning of the problem, note we bought these assets in 2018. So when we initially opened the company, we did our taxes for 2018. All right, and we just calculated depreciation we would have taken in 2018. So now we're fast forwarding to 2019. So we're going to have to take the second year's worth of depreciation for these assets, plus any new assets we purchased, which we have right down here, these 4 individual items. We need to do the initial year's depreciation for those assets. So this is what we're going to actually use for our tax return when we fill in the forms here in a bit. So if you come down to the second problem, all right, notice what we're doing here. Now we're using that second year column. So let's go back to those assets that we just looked at. All right, we got our furniture, machinery, and our truck. All right, now we're looking at our depreciation for 2019. So again, calculating depreciation for these same assets, but now for their second year of operation. All right, so the furniture was $150,000 in basis, just like what we looked at earlier, and we calculated it for 2018, so that's not going to change. All right, again, it's going to be a 7-year asset. But now we're in year 2 for that asset because we bought it in 2018. We're doing the taxes for 2019, the second year we owned it. So we come across from year 2 down from 7 years, and we get 24.49%. Notice our second asset's going to have the same percentage, right? Because again, the machinery, it's a 7-year asset as well. So the furniture, 150 times 24.49. All right, that's our depreciation for the second year for the furniture. Same deal, machinery, take it times that rate, and you get 137. Our truck, remember, that was a 5-year asset. So in year 2 for the truck, go over in the row, come down in the 5-year column, we have 32%. So 40,000 times 32%, 12.8. So our total depreciation for assets that were placed in service before 2019, and we only have these 3 assets we just started up in 2018, was 186,679. All right, so we accounted for those 3 assets. Now we want to think about, well, we bought another 4 new assets in 2019. So basically, we're going to go through the same process that we did with these guys back in 2018. We want to figure out what type of assets are these. All right, well, computers, assembly equipment, that's real tangible assets. Cars are real tangible assets as well. All right, as we've seen, we depreciated a truck here using the mid-year convention there. But difference is here, luxury automobiles have special rules. So we're going to talk about those in a bit. A storage building, keep in mind, all right, that's real, all right, property here. So if we go up, that's in the real property section. And let me clarify too that the computer systems and the equipment, that's actually personal property, but it's tangible. It's a real thing. It doesn't fall in the real property category. So I might have misspoke there earlier. Just keep in mind, trucks, equipment, furniture, that's personal property. It's something tangible and something real you could put your hands on. We're going to talk about intangible property in a minute, but it falls under personal property. A storage building, all right, that's going to go under real property. So if we're looking at this, we're going to have to use different depreciation methods for the storage building as opposed to these other assets. So we'll get to that in a second, but let's go back and do the depreciation for these first couple assets. So this computer system was $400,000. Notice here we took the $1,020,179 expense. Remember, it was bumped up 20 grand in 2019, so we're taking a little bit more depreciation expense there. And again, we applied it against that 7-year asset, the machinery equipment. All right, and notice we had a little bit left over after we applied that, so the basis for that one's $180,000. So we're going to keep that in mind when we actually calculate the depreciation on that. All right, so here is our new assets, and we're just going to do the same process. The computers, all right, if we look up here, computers are kind of under IT systems. Those are 5-year assets. All right, so what we're going to do is go back to that same little chart we used earlier, look under 5 years. All right, and notice this is the first year we bought the computer, first year in operation. We're looking at 2009, so we come under 5 years. We'll use 20% for that. All right, so you get 400,000 times 20%. We're going to take 80,000. All right, I'm going to skip over the luxury auto for a second here. We'll come right back to that. The assembly equipment, all right, that's 7-year asset class equipment. So we come over here, year 2, all right, or rather, I'm sorry, year 1, it's the first year this is in operation, this piece of equipment. We just bought it. Come under, all right, 7-year, you have 14.29%. Remember to move your decimal over when you do the calculations. Take the 180 times that, and we get 25,722. So just exactly the same as what we did earlier for 2018's initial asset purchases. Now, the luxury car is a 5-year asset, so it would go under year 1, 5-year asset, 20%. Remember, though, our rules concerning luxury automobiles, they're limited. There's actually a little limitation schedule we see here, and these are one of the links you could find at the top of this problem. Basically, if you bought something in 2019, it was placed in service, you could only take up to 10 grand in normal maker's depreciation for it. So if we look over here, even though if you take 20% times 80,000, it would come to 16 grand. All right, we can only take 10 of that because these luxury auto rules apply to that piece of equipment. So keep that in mind. If you buy a car, a typical car like a Honda Civic or something, all right, you're not going to have that issue. But if you buy one of these expensive cars, a Mercedes or Lexus or something like that, then you're going to have to kind of think back to all the limitations and rules involving luxury cars, which gets quite complicated. I'm not going to go through the details of all that, but I just wanted to reiterate that point. If it is a luxury car, a little bit different rules do apply. Now, the very last one here, the building. This is where we have a different class. And remember, this is actually that category of real property. All right, so notice this very first convention we use, the half-year convention, we can't use that for real property like buildings. All right, we have a different convention in place. And what you have to think about when you have property, is it residential or non-residential? So this is kind of a storage facility, a garage of some sort that we built or bought. So something like that. We don't have people living in it. It's non-residential. You also have to take into consideration with property when it was purchased. So we bought this in 2019. Notice this little caveat here. This charts for assets placed in service after May 1993. So if we're doing depreciation for something bought before 1993, all right, we'd use a different chart. So that's not going to really affect us here. We're in the correct chart. Now, notice we have to keep in mind when we purchased the asset. All right, so for this particular one, we placed in service in November. All right, so we look at for the first year at the month it was placed in service, the 11th month. So it's down here, come to the first year, and you get 0.321% depreciation. So I know this is a little bit tricky. It throws people off. Remember, when you convert percentages into decimal, you always got to scoot the decimal over two numbers. So right here, when I bring it down, I got to move that over. It's 0.00321. I take that times our 700,000. I got 2247 in depreciation. And we could come back and we see that number. All right, so that's doing all the calculations for the second year of operation, all the depreciation calculations. Next question here asks us basically to kind of redo that stuff, but and it's just kind of bringing all that information together here. This last one assumes the company is actually going out and purchasing another firm and they're taking over all their assets. For the sake of doing the tax return, they kind of wanted you to ignore all this stuff. They basically told you just use the facts from Part B. So I'm just going to quickly go through this and just talk about what happened. These first two parts here is just the calculations we've already done. This last section, this is the new stuff. So we went out and bought a company and we got their inventory, furniture, machinery, all that stuff, land and building. What's kind of different here is the patent and goodwill. A patent gives us the right, exclusive right to produce particular products. So we bought that patent off them. That has some value. All right, goodwill is what we paid over and above the book value of the company. All right, so things like patents and goodwill, those are intangible property, right? You can't physically touch a patent or goodwill. It's kind of an abstract notion, but they still have value. So we don't necessarily depreciate those, we amortize them. So that's just a fancy term for depreciating intangible property. Now, intangible property like this gets depreciated by 1/15 per year. So if you buy it in the middle of the year, you kind of got to prorate it for how long into the year you are. So for these assets here, what's our date? Notice we bought this company on September 15th. So if you go back through the kind of the rules dealing with intangible assets, you could actually use the full month. All right. So basically, we're going to have September, October, November, December, 4 months worth of amortization for these properties, the goodwill and patents. All right. So we take 1/15 of the value per year, but we don't have a full year. We have 4/12 of a year. All right. So for those particular assets, all right, notice I'm taking 4/12 of 1/15. All right, in the second year, what I would do is say in 2020, when I do the taxes for the goodwill, I would take 2,000 times 1/15. That would give me how much amortization expense I could take in 2020. since it's the first year of owning these intangible assets, we didn't own them for the whole year. We have to prorate it. So it's 4/12 of 1/15. So if you take 4/12 times 1/15, you get this little percentage here. You just take that times 2,000. Likewise, same percentage for the patent. All right, and you come up with these numbers here. You notice that corresponds to what we have. The building, same idea as before. You just need to go back to your chart for non-residential property, look it up, and you could do the calculation there. We've done this earlier, so I'll just kind of scroll past that. But I really wanted to focus on the intangible property here. Now, go into the tax return itself. Basically, we did all the calculations. It's just kind of knowing where to fill out the forms. And good way to kind of look at these tax returns, if you're getting stuck, they have a tax return in the book based on the problem they gave you in the chapter. So what I try to do when I'm kind of thinking through new forms like this, I go and look at the example in the book. I try to figure out where those numbers came from, then kind of apply it to the problem at hand here. Now, kind of this gets a little bit tricky. Notice they said use Part B and the information given in Part B, and use 2019 tax rolls regardless of the year on the form. So they want you to disregard this. I really wish McGraw-Hill would have just put 2019 there, because this can definitely be misleading. But we're doing the taxes for 2019 using 2019's rules. All right, so remember in 2019, the maximum amount that we could actually expense with 179, all right, is $1,020,000. So notice in this section, we're talking about our 179 rules. And remember, if we actually bought equipment, the total amount of this personal use equipment that we put in place for the year was more than 2.55 million. That's the threshold for 2019. All right, we'd start losing our 179 expense deduction. All right, so, and the reason for this is this deduction is supposed to be for small businesses. So if we put $20 million worth of new equipment into play in 2019, we're probably not a small business. That's a huge investment. So the government put that stipulation in there to try to make these rules really apply to smaller businesses. All right, notice we put $1.68 million worth of new personal equipment in play. And if I come back up here, we could see the equipment we bought during 2019. The only thing that doesn't fall into that category of personal assets is going to be the storage building. That's a real asset. So these first three things, all right, kind of similar to the assets we had in 2018. All right, that's personal assets. And again, personal assets doesn't mean personal use. It's assets that are tangible, so they're real, we can touch them, and we're using them for our business. So there's confusion with that terminology. I wish they would have came up with better terms that kind of more easily distinguishes stuff. But just keep in mind, something like a building, all right, that's not going to follow the same rule as these personal assets here. All right, so notice we have 1.2 million plus 400,000 plus 80,000. That's $1,680,000 worth of those personal assets, which are subject or eligible for that 179 depreciation exemption. So if we come back to our tax form, long story short, the whole reason I went through that was that's what you're putting on line 2. All right, so line 1, line 3, these are just numbers that are going to show up on every section of this form 4562 for 2019. This 168, that's based on our own personal numbers from how much equipment we actually bought. And notice the next few lines, we just have repeating that $1,020,000 exemption. And basically the idea that we didn't have over $2.55 million worth of these types of assets put into play means that we're not really going to have any different numbers down here. Now, notice we have to put what asset we actually ascribed the 179 deduction to. So we bought $1.2 million worth of assembly equipment in 2019. Remember, you can't choose that 179 deduction for assets we purchased in the past. So those 2018 assets, they were eligible for the 179 deduction in 2018, But in 2019, we can only take the 179 deduction for the assets actually put in place that year. So if we go back and look at those assets, let's see. Notice this is the stuff we bought in 2019, assembly equipment, 1.2 million. We applied the full amount of our 179 expense deduction to that. All right, so in that case, we're just going to draw those numbers down to this particular line. All right, so that's where that information comes from. This 186, so the next line that we're going to fill out, this is referring to those assets we bought in 2018. How much depreciation are we taking this year? Well, again, we can't take 179 depreciation, but we do have our typical maker's depreciation. That's what we calculated earlier, right? So if we go back up here to this prior calculation, right, this is how much depreciation we were taking in 2019 for the assets we bought back in 2018. So we did these calculations, comes up to 186,679. So that's where you're getting that number from. The rest of the process is basically just transcribing numbers. Notice, so these are the assets we put in place this year, 2019. All right, 5-year property with $400,000 worth of that 5-year property. And if we come down here, notice that was our computers. Also, and this is a little tricky, the luxury automobile that we bought for $80,000, that is 5-year property as well. Now, if that was just like a van that we bought for 20 grand, we would add up the 400,000 plus the 20 grand, put the total here. So we group together all assets in a certain class. The reason we didn't include the 80,000, that's going to be what we call listed property. Notice down here, we're going to have a little separate section. So that's a little specific rule to the tax form that we don't want to group that together, because even though it's 5-year property, it falls in that different category, so it comes down here. So this depreciation stuff, there's a lot of rules. It's probably the most confusing stuff you're going to see in an introductory tax class. It's tough kind of keeping track of all these. So really going through the homeworks and working through the tax forms and studying this stuff really hard is the only way you're going to pick it up. There's no other way going about it. You just kind of got to struggle through the process, and that's one of those things you pick up as you do it. All right, so you put that 400,000 there, and we just repeat the information we calculated before. All right, half year, double declining balance, 80,000. We do the same thing with a 7-year property we have. So we have 180 there in 7-year property. I notice that's our assembly equipment. All right, notice the building that we purchased. We don't put that in that particular section. All right, we have a different area, all right, for our non-residential property. Notice real property, so it's a different area. If we had residential rental property, we'd have a different area where we put it. So what we need to do is just put the amount there, the 700,000. We calculated earlier the amount of depreciation, so we're just transcribing that right there. So the last part of the process is just accounting for that listed property. If you notice, second page of this form where we handle that listed property, and basically this is just kind of transcribing that information. That luxury car that we bought for 80,000. Well, we talked about the special rules pertaining to depreciation deductions for luxury automobiles. We're only able to take 10,000 on it. So notice when you drop that down here, it says enter here on line 21 of page 1. So we just go back to page 1 and notice on line 21 down here, that corresponds with that amount we did on the second page. So basically this last line is just adding up all that depreciation we took for all those different items. All right, so I know that's a lot of information to take in. For your exam, I'm not going to be giving you like a form like this to fill out or anything. This is quite detailed, but you need to be aware of the different rules, the different main ideas. Make sure you understand what asset classes are. There's different conventions, know when they apply. Also, try to keep in mind the different types of methods that we use to depreciate assets. So this form really brings together a lot of different information. If you actually go into practice tax, this would be kind of a higher level type tax return to do. So a lot goes into a lot of complicated rules, but that's kind of why tax professionals do make a good dollar for their work. So if you put the time in to learn this, you could be well rewarded in the future. So that covers the depreciation rules. If there's any questions you have, please let me know. Have a great day.